Please remember, I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and should not be considered financial or legal advice. Insurance policies are complex, and your individual needs may vary. Always consult with a qualified professional before making any financial decisions. Imagine this for a second. You're driving home, minding your own business, and bam, a car runs a stop sign and plows right into your passenger side. Your heart is pounding, your car is a mess, but thankfully everyone is okay. After the police leave, you take a deep breath and do the one thing you're supposed to do. You call your insurance company, the company you faithfully pay hundreds, maybe thousands of dollars to every single year. And that's when the real nightmare begins. You're put on hold for 20 minutes, listening to the same horrible elevator music on a loop. You finally get a human, only to be transferred 3 different times, re-explaining your story to each person. You get a claim number and then silence. Days turn into a week. You can't get a straight answer about a rental car. The adjuster won't call you back. And you start to get that sinking feeling in your stomach that the company you trusted to protect you is now treating you like an adversary. This is the single biggest fear we all have about insurance. Not the accident itself, but the betrayal that comes after. And today we are putting one company directly under the microscope to see if they are the hero of this story or the villain. That company is Encompass Insurance. You've probably seen their name, maybe gotten a quote, but they operate in a shadow not quite as famous as the Geicos or Progressives of the world. And that mystery is exactly what we're going to solve. By the end of this deep dive, you will know with absolute certainty whether Encompass is the right choice to protect your car, your home, and your family, or if it's a costly mistake waiting to happen. We're not just going to scratch the surface. We are going to rip apart their policies piece by piece. We'll expose the hidden coverages they offer that most other companies charge extra for, but we'll also reveal the dangerous gaps they might not tell you about. We'll analyze thousands of real customer reviews, the good, the bad, and the downright ugly, to see what it's really like to file a claim with them. And most importantly, we're going to answer the billion-dollar question. Are their prices competitive? Or are you paying a premium for a brand name you might not even recognize? I've spent the last month buried in policy documents, talking to independent agents, and digging through financial strength reports so that you don't have to. My goal is to give you the insider information, the kind of clarity you can't get from a 15-minute online quote, so you can make a decision that you feel 100% confident about. So, who is Encompass? The first thing you absolutely need to know is that Encompass is not some small, independent startup. They are a wholly owned subsidiary of Allstate. That's right, one of the largest, most recognizable insurance brands on the planet. This is critical. It means Encompass is backed by the financial juggernaut of Allstate. Their ability to pay claims is rock solid, with A+ ratings from all the major financial rating agencies. So you don't have to worry about them going bankrupt after a major hurricane or a series of catastrophes. That's the good news. But it also raises a crucial question. If they're just Allstate in a different costume, why do they even exist? Why not just be an Allstate customer? The answer lies in their business model, and this is where things get really interesting. Encompass does not sell insurance directly to you. You can't go to encompass.com and get a quote. You can't call an 800 number and buy a policy. They sell exclusively through a network of independent insurance agents. These are the agents in your local town who represent multiple companies, not just one. This is a deliberate strategy. Encompass isn't trying to compete with Geico on price. They are not chasing the customer who switches insurance every 6 months to save $12. They are playing a completely different game. Their entire philosophy is built around one core idea, something they call the EncompassOne package policy. This is their secret weapon, their claim to fame. Instead of selling you a separate auto policy, and then a separate home policy, and maybe a separate umbrella policy, they bundle it all together into a single comprehensive package with one bill and one deductible. Their pitch is simple: simplicity and superior protection. They argue that by packaging everything, they can eliminate dangerous gaps in coverage that often exist between separate policies from different companies. For example, if a fire destroys your home and your car in the garage, you deal with one company, one claim, and one deductible. It sounds fantastic, right? A streamlined, elegant solution to the messy world of insurance. But here's the catch, and it's a big one. This package approach isn't for everyone. In fact, Encompass is specifically targeting a very particular slice of the American population. They are looking for what the industry calls the preferred or affluent customer. This is someone who likely owns a home, owns 2 or more vehicles, and has a good driving record and a solid credit score. They're looking for families with assets to protect, people who need more than just the bare minimum state-required liability. If you're a 22-year-old renting an apartment and driving a 10-year-old Honda Civic, Encompass probably isn't for you, and they're not trying to be. They've willingly ceded that part of the market to Progressive, the General, and others. They are hunting for the suburban family with the minivan and the SUV, the paid-off mortgage, the boat, and maybe even a vacation property. Why? Because that customer is more sticky. They are less likely to shop around every year, they are more likely to value the advice of an agent, and frankly they are more profitable. This focus on a premium customer means their policies often come preloaded with higher levels of coverage and extra features that you might not find in a standard policy from another carrier. Things like new car replacement, accident forgiveness, and high-end electronic equipment coverage are often baked right into their standard auto policies. For the right person, this can be an incredible value. You're getting a premium, feature-rich product. But for the wrong person, you could be forced to pay for bells and whistles you don't need and will never use. You can't just buy a bare-bones policy from Encompass. You have to buy into their entire package philosophy. It's an all-or-nothing proposition. This creates our central conflict. Is the EncompassOne package a golden ticket to superior protection and peace of mind? Or is it a golden cage, locking you into an expensive bundle of coverages you don't actually need? Is their reliance on independent agents a benefit, giving you a trusted advisor in your corner? Or does it just add another layer of complexity and cost? This is what we have to find out. So the first, most logical place to start is by dissecting the auto insurance policy itself. What exactly are you getting when you buy car insurance from Encompass? We need to go beyond the basics of liability and collision and look at the specific, unique features they build into their product. What are the standout benefits that might make them worth the extra premium? And more importantly, what are the fine print exclusions and limitations they hope you never have to discover during a claim? Let's dive in and break down the Encompass auto policy, coverage by coverage. First up is the absolute bedrock of any auto insurance policy, liability coverage. Now I know what you're thinking. Liability. Sounds boring. Sounds like legal jargon. But I need you to listen very closely. This is not the part of your policy you skim. This is the one coverage that can stand between you and absolute, life-altering financial ruin. This is the coverage that protects your house, your savings, your future earnings, everything you've ever worked for. Liability is not for you. It's for the other guy. It pays for the damage you cause to other people and their property when an accident is your fault. It's broken down into 2 main parts: bodily injury and property damage. Let's start with bodily injury, or BI. Imagine you're driving home on a rainy evening. You glance down for just a second to change the radio station. In that split second, the car in front of you slams on its brakes. You don't have time to react. You rear-end them hard. The driver and their passenger both get severe whiplash, and one of them needs back surgery. Their medical bills, between the ambulance, the hospital stay, the surgery, and months of physical therapy, skyrocket to over $200,000. On top of that, they sue you for pain and suffering and lost wages because they can't work. This is where your bodily injury liability coverage kicks in. It pays for their medical expenses, their lost income, their legal fees if they sue you. When you look at your policy, you'll see 2 numbers for bodily injury, like 100/300. This is insurance speak for $100,000 per person and $300,000 total per accident. So in our scenario, your policy would pay up to $100,000 for the driver's injuries and up to another $100,000 for the passengers. The total your policy will pay for all injuries in that single crash is capped at $300,000. Now here's the terrifying part. Most states have a legal minimum requirement for this coverage that is shockingly low. We're talking $2,550 in many places. $25,000 per person. Can you even imagine? A single night in an emergency room can cost more than that today. If you only have state minimum coverage and you cause that accident, your insurance pays out its $25,000 limit, and then the other driver's lawyer turns to you for the remaining $75,000, plus the cost for the other passenger, plus pain and suffering. They will come after your savings account. They will put a lien on your home. They will garnish your wages for years. This is where a company like Encompass starts to make its case. They, and the independent agents who sell their policies, will almost never recommend state minimums. They cater to a clientele that has more to lose, what the industry calls preferred or standard plus drivers. They understand that their customers have assets to protect. So they will typically start the conversation at much higher limits like 100/300 or even 250/500. Yes, it costs more. But the difference in premium between pathetic state minimum coverage and solid, responsible coverage is often less than $1 a day. It is the single best investment you can make in your financial security. Then there's the other half of liability, property damage, or PD. This is the third number in that sequence, so you might see 100/300/100. That last number means your policy will pay up to $100,000 for property you damage in an at-fault accident. This is for the other person's car, of course. But think bigger. What if you swerve to avoid a deer, lose control, and plow through someone's expensive brick fence and into the corner of their garage? What if you cause a multi-car pileup on the freeway involving a brand new Mercedes, a fully loaded F-150, and a Lexus? The average new car price in America is hovering around $50,000. The state minimum for property damage in some states is as low as $5,000 or $10,000. It's a joke. You could cause $10,000 in damage just by denting the high-tech bumper on a modern luxury SUV. Again, if you only carry the minimum, you are personally on the hook for the rest. Encompass knows this. They are insuring people who live in neighborhoods with nice fences and driveways full of new cars. Their agents are trained to advise you to carry limits of at least $100,000 to properly protect yourself. This is also the perfect time to talk about the ultimate liability shield, something Encompass and its agents are very familiar with: the personal umbrella policy. If you have a home, if you have investments, if you have a decent income, you need to know what this is. An umbrella policy is a separate insurance policy that sits on top of your auto and home insurance. It only kicks in after your primary liability limits are exhausted. They are sold in increments of $1 million. So, let's say you have those 250/500/100 limits on your Encompass auto policy. You cause a catastrophic accident where the damages are $800,000. Your auto policy pays out its $500,000 limit, and then your $1 million umbrella policy would kick in to cover the remaining $300,000. Without that umbrella, you'd be facing a $300,000 bill that could bankrupt you. For most people, a $1 million umbrella policy costs just a few $100s a year. It is the cheapest peace of mind you can buy, and it's a core part of the Encompass strategy for protecting their clients' assets. Okay, so that's liability. It covers damage you do to others. But what about injuries to you and your own passengers? That's where the next two coverages come in: medical payments and personal injury protection. Medical payments, often called MedPay, is the simpler of the two. It's an optional coverage that pays for medical and funeral expenses for you and your passengers if you're injured in an accident, regardless of who is at fault. Even if you drive into a tree, MedPay can cover your hospital bills. It's typically sold in smaller amounts like $1,000, $5,000, or $10,000. It's designed to cover immediate costs, like your health insurance deductible or copays, without having to wait for a fault-based claim to be settled. It's relatively inexpensive and can be a real lifesaver for covering those initial out-of-pocket costs. Now, personal injury protection, or PIP, is like MedPay on steroids, but it's only available or required in certain states known as no-fault states, places like Florida, Michigan, and New York. Like MedPay, PIP covers your medical bills regardless of fault, but it goes much further. PIP can also cover a percentage of your lost wages if you can't work because of your injuries. It can cover things like hiring someone to help with household chores you can no longer do. It's a much more comprehensive safety net. If you live in a no-fault state, the rules around PIP are complex and mandatory, and having a knowledgeable agent to navigate them is critical. So what's the fine print? What are the big exclusions Encompass and other insurers have for these coverages? The biggest one is intentional acts. If you intentionally drive your car into someone or something, you're on your own. There's no coverage. Another huge one is commercial use. If you're using your personal vehicle to deliver pizzas or as a rideshare vehicle for Uber or Lyft, and you haven't told your insurance company, your claim will be denied. They will see that as a business activity, which requires a commercial policy. Racing is another universal exclusion. If you're injured while street racing or participating in a track day, your MedPay and PIP won't cover you. These coverages are the foundation. They protect you from the world, and they provide a safety net for your own injuries. But we haven't even talked about the single biggest asset at risk for most people: your car itself. What happens when your $30,000, $40,000, or $70,000 vehicle is crumpled in a wreck or stolen from your driveway? How does Encompass handle paying to fix or replace your property? That's where we get into the nitty-gritty of collision and comprehensive coverage, and the special endorsements Encompass offers that can make a world of difference. Collision and comprehensive are the two pillars that protect your car. Think of it this way. Collision covers damage to your vehicle when you collide with another object, another car, a pole, a guardrail. Basically, if you're behind the wheel and you hit something, collision coverage is your best friend. Comprehensive, on the other hand, is for almost everything else. It's for the things that happen to your car. Theft, vandalism, a tree branch falling on it during a storm, hitting a deer, fire, floods, hail. This is the stuff that's generally outside of your direct control. Together, they form the shield that protects the investment sitting in your garage. Now, every insurance company offers these, but the devil, as always, is in the details. The real question isn't if they offer it, but how they handle the claim when your life gets turned upside down. Let's paint a picture. Imagine you just bought a brand new SUV. You love it. It's got that new car smell, the latest tech, and you saved up for years for that down payment. You're driving home from work one rainy evening, and the car in front of you slams on its brakes. You swerve to avoid it, lose traction on the wet pavement, and end up hitting a median. You're okay, thankfully, but your beautiful new SUV is a mangled mess. The tow truck comes, and the adjuster declares it a total loss. Here's where the road splits. With a standard run-of-the-mill policy for many carriers, they'll calculate something called the actual cash value, or ACV. This isn't what you paid for the car. It's what the car was worth the second before the crash. They'll look at the make, model, year, mileage, and then they'll factor in the killer depreciation. That new car you drove off the lot a few months ago for $40,000? The moment its tires hit public pavement, it started losing value. The insurance company might say its ACV is now only $34,000. After you pay your $1,000 deductible, you get a check for $33,000. The problem? You still owe $38,000 on your auto loan. So now you have no car, a check for $33,000, and you still have to write a $5,000 check to the bank just to close out the loan on a car that no longer exists. That's a devastating financial blow. You're left with no vehicle and a $5,000 hole in your pocket, all because of one bad moment on a rainy night. This is where Encompass steps in and changes the entire game with an endorsement that is, frankly, a must-have for anyone with a new car. It's called new car replacement. Let's rewind that same accident. You're standing on the side of the road, looking at your wrecked SUV. But this time you have the Encompass policy with new car replacement. The adjuster still declares it a total loss. But instead of cutting you a check for the depreciated value, Encompass does something different. If your car is within the first 2 model years and has under 24,000 miles, or whatever the specific terms are on your policy, they don't give you what it was worth. They give you the money to buy a brand new one. Same make, same model, current model year. Let that sink in. No fighting over depreciation. No $5,000 gap to pay out of pocket. You get to go back to the dealership and get a brand new replacement for the car you lost. You are made whole. This single feature transforms a potential financial catastrophe into a manageable inconvenience. It protects your investment at its most vulnerable point, the first couple of years when depreciation hits the hardest. It's the difference between starting over from scratch and simply getting back on the road. But the pain of an accident isn't just about the vehicle itself. It's the aftermath. It's that sinking feeling in your stomach when you think, my rates are going to go through the roof. After a major at-fault accident, many drivers see their premiums spike by 30, 40, even 50% or more at their next renewal. That increase can stick around for 3 to 5 years, costing you thousands of dollars over time. It feels like being punished over and over again for one mistake. Encompass addresses this fear directly with another one of their signature offerings, accident forgiveness. The concept is simple but powerful. If you've been an Encompass customer with a clean driving record for a certain period of time, they will forgive your first at-fault accident. This means that after that terrible, stressful event, you don't have to live in fear of that renewal notice. Your rates won't increase because of that one specific incident. It's a reward for being a loyal, safe driver. It acknowledges that good drivers can have bad days. It provides peace of mind, knowing that a single mistake won't penalize you financially for years to come. Now, let's go back to that financial gap we talked about, the difference between what your car is worth and what you owe on it. The new car replacement feature is amazing for the first couple of years, but what if your car is 3 or 4 years old? You might still be upside down on your loan, owing more than the car's actual cash value. For this scenario, Encompass offers another crucial piece of the puzzle, Loan/lease gap coverage. This endorsement is designed specifically to pay off that difference. So, if your 4-year-old car is totaled, and the ACV is $20,000 but you still owe $23,000 on the loan, gap coverage pays that $3,000 difference. Again, it prevents you from having to pay out of pocket for a car you can no longer drive. It ensures that a total loss doesn't become a long-term debt. These special features, new car replacement, accident forgiveness, and gap coverage, are what elevate a policy from basic to premium. They are designed to solve the real-world, high-stress problems that arise after an accident. It's not just about meeting the legal requirements of being insured. It's about creating a financial safety net that truly protects you. And it's not just for major collisions. Let's talk about comprehensive coverage again. Imagine a massive hailstorm rolls through your town. Your car parked outside now looks like a golf ball. It's covered in dents. This is a classic comprehensive claim. Or maybe you come out of the grocery store to find a shopping cart has been blown by the wind into your door, leaving a nasty scratch and a dent. Vandalism. Comprehensive claim. Or the most common one. A rock gets kicked up by a truck on the highway and puts a giant crack in your windshield. With Encompass, depending on your state and policy, you might have a $0 deductible for glass repair. You make a call, a technician comes to your home or office, and your windshield is fixed without you paying a dime. It's these small, thoughtful coverages that reduce the daily frictions of car ownership. So when you look at an Encompass policy, you have to look beyond the basic liability numbers. You have to see how they handle the physical damage to your property. Are they just going to give you a check for a depreciated, used version of what you lost? Or are they going to provide a pathway to make you whole again, with a brand new car, a forgiven accident, and no leftover debt? This is the core difference. It's a philosophy that recognizes your car is more than just a depreciating asset. It's an essential part of your life and a major financial investment. But protecting your own car is only half the battle. We've covered what happens if you're at fault, and what happens if an act of nature damages your car. But what happens when the person who hits you is the problem? What happens when they speed through a red light, T-bone your car, and you find out they have zero insurance? Or a joke of a policy with the bare minimum limits that won't even cover your medical bills, let alone your totaled vehicle. That's when your own policy becomes your only line of defense. And we're about to uncover a coverage that might be the most important one you've never thought about. That coverage is called uninsured and underinsured motorist protection. And I know it sounds like dry, boring insurance jargon, but I promise you by the end of this, you will understand why it is arguably the most critical and selfless purchase you can make for you and your family. It is the one coverage that truly acts as your personal financial bodyguard when the system fails you. Let's paint a picture. You're driving home from work, maybe picking up groceries. You're stopped at a red light, humming along to the radio. Suddenly, bam, a violent jolt from behind. Your head snaps back. Your car is shoved into the intersection. You're dazed, your neck is screaming in pain, and your brand new SUV now has a trunk where the back seat used to be. The other driver is apologetic, but when the police arrive and ask for insurance, he just shrugs. He doesn't have any. Not a single dollar of coverage. He let it lapse months ago. So now what? His irresponsibility just caused you tens of thousands of dollars in damage, sent you to the emergency room, and will likely cause you to miss weeks of work. Who pays for that? Do you sue him? You can, but what are you going to get? If he couldn't afford a basic insurance policy, it's almost certain he doesn't have $100,000 in assets sitting around for you to claim in a lawsuit. This is the nightmare scenario. You did everything right, and you're left holding the bag for someone else's catastrophic mistake. This is precisely where uninsured motorist coverage, or swoops in to save your financial life. Think of it this way. Uninsured motorist coverage essentially steps into the shoes of the at-fault driver who had no insurance. Your own insurance company, in this case Encompass, behaves as if they were the other driver's insurer, and they pay you for your damages. There are two key parts to this. First is uninsured motorist bodily injury, or UMBI. This is the big one. This pays for your medical bills, your passengers' medical bills, your ambulance ride, the physical therapy you'll need for the next 6 months. But it goes further. It also covers lost wages. If you're a contractor, a freelancer, or anyone who doesn't get paid if they don't work, this is your lifeline. It can even compensate you for pain and suffering. It's designed to make you whole again after someone with no insurance turns your life upside down. The second part is uninsured motorist property damage, or UMPD. This covers the damage to your car. Now, if you already have collision coverage, which we'll talk about in the next part, this might seem redundant. But UMPD can be crucial. In some states, it can be used to pay your collision deductible, saving you $500 or $1,000 out of pocket. In other states, for people who choose not to carry collision coverage on an older car, UMPD is the only thing that will pay to fix or replace their vehicle in this situation. So, uninsured motorist is for when the other guy has nothing. But what about the scenario we touched on in the last part? The one that's actually far more common? The driver who has insurance, but only the bare-bones, state-mandated minimum. Let's go back to our crash. Same scenario, but this time the driver who hit you proudly hands the officer an insurance card. He's legal. He has a policy. The problem? He has the state minimum liability limit of, say, $25,000. Your initial hospital visit, the MRI on your neck, and the ambulance ride alone cost $30,000. Your car is a total loss, valued at $40,000. The other driver's policy will write you a check for their maximum limit, $25,000, and then they will wish you the best of luck. They have fulfilled their legal obligation. You are still left with $5,000 in immediate medical debt, a destroyed car, and you haven't even started the months of physical therapy or accounted for the time you'll miss from work. You are catastrophically underfunded. This is where the second half of this dynamic duo comes in. Underinsured motorist coverage, or UIM. This coverage is pure genius. It bridges the gap. It activates when the at-fault driver's liability limits are not enough to cover your damages. In our example, after you receive the $25,000 from the other driver's insurance, you would then file a claim with Encompass under your own underinsured motorist policy. If you had a UIM limit of, say, $250,000, your policy would step in to cover the rest of your medical bills, lost wages, and other damages all the way up to that limit. It is the ultimate safety net. It protects you from the irresponsible choices of others. Now, let's talk about how Encompass structures this and the single most important piece of advice I can give you. When you select your policy limits with Encompass, you will choose your own bodily injury liability limits. That's the coverage that pays for others if you cause an accident. Let's say you choose $250,000 per person and $500,000 per accident. My advice, and the advice of nearly every financial expert, is to match your uninsured and underinsured motorist limits to your own liability limits. Think about the logic here. You selected a $250,000 liability limit because you believe it's possible to cause that much harm in an accident, and you want to protect your own assets from a lawsuit. So why on earth would you give yourself and your family less protection than you're willing to give a complete stranger? If you're protecting your assets from others, you should be using that same level of protection for your own health and financial well-being. Opting for the state minimum on UM/UIM, while carrying high liability limits, is like buying a state-of-the-art security system for your house, but leaving your own bedroom door unlocked with the key under the mat. It makes no sense. With Encompass, insist on matching these limits. It is the responsible thing to do. But Encompass, in states where it's allowed, offers a way to supercharge this protection. It's a concept called stacking. This is a little more advanced, but it's so powerful you need to know about it. Let's say you have 2 cars on your Encompass policy, and you have UM/UIM limits of $100,000. If you choose an unstacked policy, that $100,000 limit is the most you can collect, period. But if your state allows it and you opt for a stacked policy, you may be able to combine or stack the limits for each car. So with 2 cars, your $100,000 limit could effectively become a $200,000 limit. With 3 cars, it could become $300,000. This provides a massive increase in your potential coverage, and the best part is the additional cost for stacking is often shockingly small. It can be just a few extra dollars a month for an exponential increase in protection. When you're getting a quote from Encompass, you absolutely must ask about the cost difference between stacked and unstacked coverage. It is one of the best bargains in the entire insurance industry. You might be thinking, what are the odds of this really happening? Well, according to the latest data from the Insurance Research Council, about 1 in 8 drivers on the road in the United States is uninsured. 1 in 8. Look at the next 8 cars that pass you on the street. Statistically, 1 of them has no insurance. And that doesn't even count the massive number of drivers who are only carrying the legal minimum, which, as we've seen, can be woefully inadequate in a serious crash. This isn't a rare black swan event. It is a common, everyday risk you take every time you get behind the wheel. Your health, your ability to earn an income, and your financial stability are your most valuable assets. Uninsured and underinsured motorist coverage is the armor you buy to protect them. It is not a place to cut corners. The difference in premium between a state minimum UM/UIM policy and a robust $250,000 or $500,000 stack policy is often less than the cost of a few cups of coffee a month. But the difference in outcome after a major accident is life-altering. It's the difference between a full recovery and a lifetime of medical debt. So you've now protected yourself from the financial fallout of an uninsured driver's negligence. You've built a fortress around your health and your income. But what about protecting the physical car itself? What about the things that are completely out of anyone's control? A hailstorm that turns your car into a golf ball, a deer that decides to play chicken at midnight, or a thief who sees your car as their next prize. That's where your policy needs to become a shield against chaos, and the next two coverages we'll break down are the ones that do exactly that. Let's start with the one most people are familiar with, even if they don't know it by name: collision coverage. Imagine this. You're navigating the chaos of a Trader Joe's parking lot on a Saturday. You're backing out slowly, you've checked your mirrors, you've craned your neck. But out of nowhere, another driver trying to snag a spot you just freed up zips in behind you. Crunch. It's that sickening sound of metal and plastic meeting in a way they were never designed to. Your rear bumper is now a modern art sculpture, and their front fender is pushed in. Who's at fault? Maybe it's you, maybe it's them, maybe it's a 50-50 split. In the heat of the moment, with witnesses pointing fingers and emotions running high, the last thing you want to worry about is how you're going to pay to fix your own car. This is where collision coverage steps in like a superhero. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another vehicle, but it could also be a streetlight, a guardrail, a garage door you forgot was closed, or even a pothole that flips your car. The most important thing to understand about collision is that it covers your car regardless of who is at fault. If the other driver is at fault, their liability insurance should pay for your damages. But what if they don't have insurance? What if they have low limits that don't cover the full cost of your brand new SUV? What if it's a hit and run? Or what if the accident is deemed to be your fault? Without collision coverage, you are on your own. You're paying out of pocket for every single dollar of that repair. With an Encompass policy that includes collision, you file a claim, you pay your deductible, and they handle the rest. Now that word, deductible, is probably the most critical part of this equation. A deductible is the amount of money you agree to pay out of pocket for a claim before the insurance company starts paying. Think of it as your share of the risk. Encompass, like most insurers, offers a range of deductible options, typically from $250 up to $2,500. Let's use our parking lot scenario. Say the repair bill for your bumper comes to $3,000, and you have a $500 collision deductible. You pay the first $500 to the body shop, and Encompass pays the remaining $2,500. If you had chosen a $1,000 deductible, you'd pay $1,000, and they'd pay $2,000. So why wouldn't everyone just pick the lowest deductible? Because there's a trade-off. It's a fundamental seesaw of insurance. The lower your deductible, the higher your premium will be. The higher your deductible, the lower your premium. By choosing a higher deductible, you're telling the insurance company, I'm willing to take on more of the financial risk myself in a small accident, so you should charge me less for my policy. Choosing the right deductible is a personal financial decision. The golden rule is to never choose a deductible that you couldn't comfortably pay in cash today without causing a major financial crisis. If a surprise $1,000 bill would force you to rack up credit card debt or skip a mortgage payment, then a $1,000 deductible is too high for you. For many people, the $500 deductible is the sweet spot, but you need to run the numbers and be honest with yourself about your emergency savings. Now, collision coverage handles the crunch. But what about all the other chaos life throws at your car? This brings us to its equally important partner, comprehensive coverage. Some companies call it other than collision coverage, which is a clunky but incredibly accurate name. It's the coverage for almost everything else. Remember that deer who wanted to play chicken at midnight? If you swerve to miss it and hit a tree, that's a collision claim. But if you hit the deer itself, that's a comprehensive claim. Sounds weird, but that's how it works. Hitting an animal falls under comprehensive. And that's just the beginning. Comprehensive is your shield against a whole catalog of unfortunate events. A hailstorm turns your car's hood into a golf ball? Comprehensive. A massive oak branch snaps off in a windstorm and lands on your roof? Comprehensive. You're parked downtown and a thief smashes your window and steals your car? Comprehensive. Your engine catches fire, there's a flood? or vandals decide to key your paint job from end to end. All of these are covered by comprehensive. It's the coverage for events that are almost entirely out of your control. These are often called acts of God or acts of nature. But it also includes man-made malice like theft and vandalism. Just like collision, comprehensive coverage has its own deductible. And here's a pro tip. Your comprehensive deductible does not have to be the same as your collision deductible. Because comprehensive claims tend to be less frequent and often less severe than collision claims, the coverage itself is usually much cheaper. This means you can often opt for a lower comprehensive deductible, say $250, without it dramatically increasing your total premium. This is a great strategy because it makes it more affordable to fix things like a cracked windshield from a rock on the highway, which is one of the most common comprehensive claims. When you're getting that Encompass quote, look at the price difference between a $500 and a $250 comprehensive deductible. You might be surprised at how small it is. So now you have liability to protect you from others, and you have collision and comprehensive to protect your own car. When people talk about having full coverage, this is what they mean. It isn't an official insurance product you can buy. It's industry slang for a policy that bundles these three core components together. It creates a complete bubble of protection around you and your vehicle. The final question is, do you actually need both collision and comprehensive? The answer is a hard yes in one specific situation. If you have a loan on your car or if you're leasing it, your lender or leasing company has a financial stake in your vehicle. It's their asset until you pay it off. They will absolutely 100% require you to carry both collision and comprehensive coverage to protect their investment. If you total the car, they want to make sure their loan gets paid back. If you drop this coverage while you still have a loan, you're violating your financing agreement, and the lender can actually buy a policy for you called force-placed insurance and tack the exorbitant cost onto your loan payment. Don't let that happen. But what if you own your car outright? What if it's a 12-year-old Honda with 180,000 miles? This is where you need to do some math. Insurance companies will only ever pay out up to the actual cash value, or ACV, of your vehicle at the time of the loss. ACV is basically the market value, what a willing buyer would pay for it, right before the accident minus depreciation. It is not what you paid for it, and it's not the cost of a brand new car. So grab your car's information and look up its value on a site like Kelley Blue Book. Let's say your old Honda is worth about $4,000. Now look at your Encompass policy declaration page. How much are you paying per year specifically for the collision and comprehensive portion of your premium? Let's say it's $600 per year. And let's say you have a $1,000 deductible. In a worst-case scenario, if you total the car, the most the insurance company would pay you is $3,000, $4,000 ACV minus your $1,000 deductible. Is it worth paying $600 per year to protect yourself against a maximum potential loss of $3,000? For some, the peace of mind is worth it. For others, it might be time to consider dropping these coverages. A good rule of thumb is this. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's value, it's time to seriously evaluate whether you should keep it. You could take that $600 you save on premiums and put it into a dedicated car repair/replacement savings account. You'd be self-insuring. This is a risk, but it can be a financially savvy one for the right person with an older, low-value vehicle. These two coverages, collision and comprehensive, are the heart of protecting your physical car. They are what transform a policy from a simple legal requirement into a powerful financial tool that protects your assets from the unpredictable and the unfortunate. But we're not done building our perfect policy. There's another layer of protection that is absolutely critical, especially in a country where medical bills can be astronomical, and that's what we're going to cover next. This layer is all about protecting the most valuable thing in any accident: human health. Your family's health. Let's talk about medical payments coverage, or MedPay, and its more comprehensive cousin, personal injury protection, or PIP. Now, a lot of people hear this and immediately think, wait, I have health insurance. Why would I pay for medical coverage on my car insurance policy? Isn't that redundant? That is a perfectly logical question, but it's based on a dangerous misunderstanding of how these systems work, especially after a car crash. The gap between what your health insurance covers and what you actually owe can be a financial canyon, and MedPay or PIP is the bridge that gets you safely to the other side. Let's start with the basics. Both MedPay and PIP are designed to pay for medical expenses for you and your passengers after an accident, regardless of who was at fault. Let me say that again because it's the most important part, regardless of who was at fault. This is immediate first-dollar coverage. There's no waiting for lawyers to argue for 6 months about whether the other driver was 70% or 80% responsible. You get into an accident on Tuesday, you go to the hospital on Tuesday, and your MedPay or PIP coverage kicks in on Tuesday. This speed is a lifesaver, and I mean that both medically and financially. Imagine a simple scenario. You're in a fender bender. The other driver clearly ran a stop sign. It's their fault, but you've tweaked your neck and your back. And your son in the back seat has a nasty bump on his head. You go to the emergency room. You need x-rays, maybe a CT scan. The bill is $4,000. Your health insurance has a $5,000 deductible. So, who pays that $4,000 right now? You do. You have to put it on a credit card or drain your savings, all while hoping and praying that the other driver's insurance company will eventually accept liability and reimburse you. That could take months, even over a year. Meanwhile, the hospital's billing department doesn't care whose fault it was. They want their money, and they'll send collections after you. Now rewind that same scenario, but this time you have a $10,000 MedPay limit on your Encompass policy. You go to the ER. The bill is $4,000. You give them your auto insurance information. Encompass pays the bill directly. Done. No deductible, no copay, no stress. You can focus on getting better, not on fighting with billing departments while you're in pain. MedPay typically covers things like ambulance rides, hospital visits, doctor's bills, surgery, x-rays, and even things like dental work if your teeth are injured in the crash. It's clean, simple, and fast. But then there's its big brother, personal injury protection, or PIP. If you live in a no-fault state like Florida, Michigan, or New York, you're likely required to carry PIP. And let me tell you, even if you're not required, it's an incredible safety net. PIP does everything MedPay does, but it goes even further. The single most powerful benefit of PIP is that it can cover lost wages. Think about that. Your health insurance will never ever pay you for the 2 weeks of work you missed because you were recovering from a concussion. But PIP can. If you're a gig worker, a freelancer, or you just don't have a generous sick leave policy at work, a car accident can instantly turn into a financial catastrophe. You have medical bills piling up at the exact same time your income drops to zero. PIP steps into that gap and helps keep your family afloat. It can also cover things like replacement services. If you're laid up with a broken leg and can't take care of your kids or clean your house, PIP can help pay for childcare or a cleaning service. It's designed to help you maintain your life while you recover. This is where a premium carrier like Encompass really separates itself from the budget insurers. Encompass understands that true protection isn't just about fixing your bumper. It's about protecting your entire life from the chaos an accident can cause. Their agents are trained to walk you through these options, not just to sell you the cheapest possible policy. They'll look at your health insurance deductible, your job, your family situation, and help you choose a MedPay or PIP limit that actually makes sense for you. They might offer limits of $5,000, $10,000, $25,000, or even more. And while it might add a few dollars to your monthly premium, the return on that investment is astronomical if you ever need it. Let me paint a picture for you with a story about two neighbors, Mark and Sarah. They live on the same street, drive similar cars, and work in the same office park. One rainy morning, they're both involved in the same multi-car pileup on the freeway. Both cars are damaged, and both Mark and Sarah suffer moderate whiplash and back injuries. Here's where their stories diverge. Mark has a bare-bones policy he bought online. He declined MedPay to save $12 a month, figuring his health insurance was good enough. He has a $6,000 family deductible. The ambulance ride is $1,500. The ER visit with imaging is $5,000. He immediately owes $6,500 out of pocket. He has to miss a week of work, losing about $1,500 in pay. His doctor recommends 6 weeks of physical therapy twice a week. His health insurance copay is $50 per visit. That's another $600. So within 2 months, Mark is nearly $10,000 in the hole, all while dealing with constant pain, a stressful insurance claim against the at-fault driver, and the fear of falling behind on his mortgage. Sarah, on the other hand, has an Encompass policy with $25,000 in PIP coverage. Her experience is completely different. The ambulance and ER bills? Paid for by PIP. The physical therapy copays? Paid for by PIP. The $1,500 in wages she lost for missing a week of work? She submits her pay stubs and PIP sends her a check. Her total out-of-pocket cost is zero. She isn't hounded by medical bill collectors. She isn't stressing about her finances. All of her energy goes into one thing, her recovery. Which of those two situations would you rather be in? For the cost of a couple of fancy coffees a month, Sarah bought herself financial peace of mind during one of the most stressful times of her life. This coverage is also for your passengers. This is huge. If you're driving your friends to a concert or your sister to the airport and you get in an accident, your MedPay or PIP covers them too. It saves you from the horrifyingly awkward and potentially relationship-destroying scenario where your friend has to sue you to get their medical bills paid. With this coverage, it doesn't matter who was at fault. Their bills get paid, period. It protects your relationships just as much as it protects your finances. So when you're building your Encompass policy, don't just gloss over the medical section. Ask the hard questions. What is my health insurance deductible? Do I have paid sick leave? What happens to my family's income if I can't work for a month? The answers to those questions will tell you just how much MedPay or PIP you truly need. Skimping here is like packing a first aid kit with nothing but a single Band-Aid. It might make you feel like you're prepared, but when you actually need it, you'll find it's terrifyingly inadequate. Choosing a robust MedPay or PIP limit is one of the smartest, most responsible decisions you can make. It's the ultimate defense against an accident turning a medical problem into a devastating financial crisis. So we've covered your car, we've covered the other guy's car, and now we've covered the people inside your car. But what happens when the other guy has no insurance at all? Or not nearly enough? That's a terrifyingly common scenario, and it's where our next piece of the puzzle comes in. This is a situation that sends a shiver down the spine of every responsible driver. You do everything right. You pay your premiums, you drive safely, you have good coverage. Then one day, a reckless driver runs a red light and plows into you. You're hurt, your car is wrecked, and you discover the person who caused it all has zero insurance. Nothing. Now what? Your medical bills are your problem. Your lost wages are your problem. Your pain and suffering? Legally their fault, but good luck collecting a dime from someone who couldn't even afford the state minimum insurance. This isn't some rare freak occurrence. The Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured. 1 in 8. That means in any decent-sized traffic jam, you're likely surrounded by several people who represent a complete financial black hole if they hit you. This is precisely why uninsured motorist bodily injury coverage, or isn't just an add-on. It's an absolute necessity for your financial survival. Think of it this way: liability coverage is you buying insurance to protect other people from you. Uninsured motorist coverage is you buying insurance to protect yourself from irresponsible people. It steps in and acts like the at-fault driver's insurance that they should have had. It pays for your medical expenses, your passengers' medical expenses, and critically, it also covers lost wages if you can't work because of your injuries. But here's the part many people miss, and it's arguably the most important. Uninsured motorist coverage can also pay for pain and suffering. This is the compensation for the physical pain, the emotional distress, the trauma, and the disruption to your life caused by the accident. If you're hit by a driver with good insurance, their liability policy pays for this. If you're hit by an uninsured driver, your coverage is your only path to being compensated for that immense personal toll. Without it, you get nothing. Now there's an even more common, more insidious problem. The underinsured driver. This is the person who did the absolute bare minimum. They bought a policy online for a rock-bottom price that only meets the state's legal requirements. In many states, that minimum for bodily injury liability might be just $25,000 per person. It sounds like a lot of money until you have a real accident. A single night in the hospital, an MRI, a surgery for a broken bone. That can blow past $25,000 before you're even discharged. And what if you need months of physical therapy? What if you're out of work for half a year? That driver's pathetic $25,000 policy is exhausted almost instantly, and the rest of that massive financial burden, hundreds of thousands of dollars potentially, falls squarely on your shoulders. You could sue them personally, sure, but the kind of person carrying minimum limits usually doesn't have significant assets to go after. You can't get blood from a stone. This is where underinsured motorist coverage, or becomes your financial lifeboat. It kicks in where the other driver's insurance leaves off. Let's say you have a serious accident, and your medical bills and lost wages total $100,000. The at-fault driver has the state minimum $25,000 policy. Their insurance pays that $25,000, and then your underinsured motorist coverage can step in to cover the remaining $75,000, up to your policy limit. Without UIM, that 75 grand would come out of your savings, your retirement, or a lien against your house. It is the very definition of a financial catastrophe. So, how does Encompass handle this critical protection? This is an area where a more premium carrier like Encompass can really shine. They typically encourage and allow you to purchase UM/UIM limits that match your own liability limits. If you have 250/500 liability coverage to protect your assets, it makes zero sense to have a tiny 25/50 UM/UIM limit protecting you from others. You should protect your own family with the same level of coverage you provide to strangers. Encompass also offers a feature in many states that is one of the most powerful, yet least understood, concepts in auto insurance: stacking. Let's say you have 2 cars on your Encompass policy, and you've chosen a UM/UIM limit of $100,000 per person. If you choose to have stacked coverage, you can essentially combine or stack the limits from both of your cars for a single accident. So, if you're hit by an uninsured driver while driving car number 1, you don't just have $100,000 of coverage. You have $200,000 of coverage available, $100,000 from each car on the policy. If you have 3 cars, you'd have $300,000. It's an incredibly powerful way to multiply your protection for a relatively small increase in your premium. The alternative is non-stacked, where you can only use the limit of the specific car you were in at the time of the accident. When you're getting a quote, always ask about the cost difference between stacked and non-stacked. The extra safety net is often worth every penny. Now, all of this has focused on your body, your medical bills, and your well-being. But what about your car? If an uninsured driver totals your brand new SUV, their non-existent insurance policy isn't going to buy you a new one. This is where a separate but related coverage comes into play: uninsured motorist property damage, or UMPD. This coverage is designed specifically to pay for the repairs to your vehicle, or its cash value if it's totaled, when you're hit by a confirmed uninsured driver. But wait, you might be thinking, doesn't my collision coverage already do that? And you're right, it does. You can absolutely use your own collision coverage in this scenario. So why would you ever need UMPD? The answer comes down to one simple, beautiful word: deductible. Collision coverage almost always has a deductible, typically $500 or $1,000, that you have to pay out of pocket before the insurance company pays the rest. But uninsured motorist property damage often has a much lower deductible. In many states, it might be just $250, $100, or sometimes even zero. Think about that. Getting your car fixed for a $250 out-of-pocket cost instead of $1,000 is a huge win. The catch is that UMPD is not available in every state, and it often has a coverage cap. It might only pay up to, say, $25,000 for your car's damages, which might not be enough if you have a very expensive vehicle. In that case, you'd still have to fall back on your collision coverage. But for the vast majority of vehicles, UMPD is a fantastic, cost-effective layer of protection against the financial irresponsibility of others. It prevents you from being penalized with a high deductible for an accident that was 100% not your fault. When you look at your policy, you should see these coverages as non-negotiable. Don't skimp here. The few dollars you might save by lowering or rejecting your UM/UIM and UMPD coverages are dwarfed by the life-altering risk you're taking on. You're betting your entire financial future that every single one of the millions of uninsured and underinsured drivers will magically never cross your path. That is a terrible bet to make. So now you're protected from the other guy, whether they're insured or not. But all of these coverages have focused on what happens when another driver is involved and at fault. What about the patch of black ice on a winter morning? The deer that leaps out of the woods at dusk? Or the shopping cart that mysteriously rolls into your door in a windy parking lot? In those cases, there's no one else to blame. The financial responsibility falls squarely on you, and on the 2 most important and most misunderstood coverages in all of auto insurance: collision and comprehensive. These are the 2 coverages designed to protect the single biggest investment sitting in your driveway: your car. They are your financial shield against the chaos of the world, and they work in very different, but equally critical ways. Let's start with collision. The name is pretty straightforward, but its application is what trips people up. Collision coverage pays to repair or replace your car after it's damaged in, well, a collision. But here's the key. It's primarily for when the collision is your fault. Think about it. That moment of panic when you're driving on a cold morning, you hit a patch of black ice you didn't see, and your car slides gracefully, almost in slow motion, into a guardrail. Or you're pulling into a tight parking spot. You misjudge the distance, and hear that gut-wrenching crunch as your bumper meets a concrete pillar. Even a simple rear-end accident where you just didn't stop in time. In all of these scenarios, there's no other driver to hold responsible. The fault is yours. Without collision coverage, the bill for that crumpled fender, that broken axle, that deployed airbag, it's coming straight out of your bank account. With collision coverage, you're protected. Now, this protection comes with a crucial component: your deductible. The deductible is the amount of money you agree to pay out of pocket before the insurance company starts paying. Think of it as your share of the repair cost. A common deductible is $1,000. So, if that guardrail incident causes $5,000 in damage, you pay the first $1,000, and Encompass pays the remaining $4,000. If the damage is only $800, you'd pay the full amount yourself, because it's less than your deductible. You wouldn't even file a claim. This is where you get to customize. You can choose a lower deductible, say $250 or $500. This feels safer, right? A smaller out-of-pocket hit if something happens, but it means you'll pay a higher premium every month. On the flip side, you can choose a higher deductible, maybe $1,500 or $2,000. This will lower your monthly premium, sometimes significantly, but you have to be honest with yourself. Could you comfortably write a check for that higher amount tomorrow if you had to? It's a balance between monthly cost and your emergency savings. And one more thing on collision: if you have a loan or a lease on your car, the bank or finance company will almost certainly require you to carry it. Why? Because until you pay it off, it's their asset and they want to make sure it's protected. So that's collision. Covers you when you hit something. But what about when something hits you? And I don't mean another car. This is where the second and arguably more versatile coverage comes in: comprehensive. The official name is actually other than collision coverage, which is a perfect description. It protects your car from just about every other bad thing you can imagine that isn't a direct result of you colliding with another vehicle or object. This is the coverage for the true acts of God and freak accidents. A deer leaps out of the woods at dusk and you can't avoid it. That's a comprehensive claim. A massive hailstorm rolls through and leaves your car looking like a golf ball. Comprehensive. A windstorm knocks a heavy branch off a tree, and it lands right on your roof. Comprehensive. You walk out to your car in a parking lot to find someone has maliciously keyed the entire side panel. Vandalism. That's a comprehensive claim. And of course the big ones: your car is stolen, it catches fire, or it's damaged in a flood. All of these fall under comprehensive. It's your protection against the unpredictable. Remember that runaway shopping cart from the windy parking lot? That's a classic comprehensive claim. It's damage that wasn't a collision, and it certainly wasn't your fault. Just like collision, comprehensive has a deductible that you choose, and it works the exact same way. Now, this is where a company like Encompass starts to separate itself from the pack. They don't just offer these basic coverages. They build on them with powerful features, especially in their deluxe and elite tier packages. This is where you move from just being covered to being well protected. One of the most valuable features they offer is new car replacement. And this is huge. Let's play out a standard scenario. You buy a brand new car for $40,000. A year and a half later, it gets totaled in an accident. Because of depreciation, the car's actual cash value might only be $32,000. That's what a standard insurance policy will pay you. You're out $8,000 and you don't have enough to go buy the same new car again. It's a devastating financial hit. Encompass New Car Replacement flips that script. If your car is totaled within the first 2 model years and has fewer than 24,000 miles, they won't just give you its depreciated value. They will pay to replace it with a brand new car of the same make and model. That $8,000 gap? It vanishes. You're made whole. You get to go back to the dealership and start over without that massive financial loss. This single feature can be worth thousands and provides incredible peace of mind for anyone with a new vehicle. Another game changer often bundled in these packages is accident forgiveness. We all have that fear. You have a perfect driving record for 10 years. Then one moment of distraction leads to a minor fender bender that's your fault. Suddenly, you're bracing for your insurance rates to skyrocket for the next 3 to 5 years. Accident forgiveness is basically a get-out-of-jail-free card. With Encompass, your first at-fault accident is forgiven. Your rates won't go up because of it. It's like a mulligan for your driving record. Knowing you have that safety net allows you to drive with less anxiety, secure in the knowledge that one mistake isn't going to cost you hundreds or even thousands of dollars in premium increases over the next few years. And then there's loan or lease gap coverage. This is absolutely essential if you're financing a car. We talked about depreciation. It's very common, especially in the first few years of a loan, to be upside down, meaning you owe the bank more than the car is actually worth. So if your car worth $32,000 is totaled, but you still owe the bank $35,000 on your loan, standard insurance gives you the $32 grand. You are then responsible for paying that remaining $3,000 difference to the bank for a car you can no longer drive. It's the definition of adding insult to injury. Gap coverage pays that difference. It covers the gap between what the car is worth and what you owe, ensuring you can walk away from the loan free and clear. So, with all this protection, the big question becomes, do you actually need collision and comprehensive? If your car is financed, the answer is yes, it's not optional. But what if you have an older car that's fully paid off? Let's say you drive a 12-year-old sedan that's worth maybe $4,000. Is it worth paying hundreds of dollars a year for collision and comprehensive coverage? This is a personal financial decision, but here's a simple framework to help you decide. First, use the 10% rule. Look at the annual cost for just your collision and comprehensive coverages. If that cost is more than 10% of your car's cash value, it might be time to consider dropping them. For that $4,000 car, if the coverage costs more than $400 a year, the math starts to look questionable. Second, and more importantly, is the sleep at night test. Ask yourself this: if I walked outside tomorrow and my car was gone or totaled, could I afford to repair or replace it with cash from my savings without causing a major financial crisis in my life? If the answer is a confident yes, then you might be in a position to self-insure and drop the coverages. But if the thought of suddenly having to come up with $4,000, $5,000, or $6,000 for another car fills you with dread, then you absolutely need to keep the coverage. It's not just about the math. It's about your financial stability and your peace of mind. Ultimately, these two coverages are about protecting your property. Liability, which we covered before, is about protecting other people from financial harm you cause. Collision and comprehensive are about protecting yourself from having to replace your own vehicle out of pocket. They are the core of any policy that does more than just meet the legal minimum. But we've now covered damage to other people's cars and damage to your own car. What about damage to the most important thing of all? What about you? What about your passengers? What happens when your medical bills start piling up after an accident? And what's the single biggest nightmare scenario for a responsible driver? Getting hit by someone who has no insurance at all. That's the scenario that keeps responsible drivers up at night. You do everything right. You buy a safe car, you obey the speed limit, you pay your insurance premium on time every single month. And then, in a split second, your financial future is threatened by someone who did everything wrong. According to the Insurance Research Council, 1 in 8 drivers on the road is uninsured. In some states like Mississippi and Florida, it's closer to 1 in 4. Think about that. On your average commute, you will pass dozens, if not hundreds, of drivers who have zero ability to pay for the damage they might cause you. This is not a risk. This is a statistical certainty. This is precisely why uninsured and underinsured motorist coverage, or UM/UIM, isn't just an add-on. It is an absolute, non-negotiable necessity for your own protection. It's your shield against the financial irresponsibility of others. Let's break it down because there are two critical parts to this. First, you have uninsured motorist bodily injury, or UMBI. This is the big one. If an uninsured driver hits you and you or your passengers are injured, your UMBI coverage steps in to pay for your medical bills, your lost wages, and even your pain and suffering. It essentially acts like the liability coverage the other driver should have had. Without it, you're left to sue a person who likely has no assets to begin with, leaving you holding a mountain of medical debt. Imagine you're in an accident that wasn't your fault. You need surgery, physical therapy, and you're out of work for 3 months. Your medical bills are $80,000, and your lost wages are $15,000. The driver who hit you? No insurance, no job, no assets. A total dead end. If you have a UMBI policy with limits of $100,000 per person, your own insurance company, in this case Encompass, steps in and covers those costs. Your financial life is saved. If you don't have it, you're on your own. This coverage is so important that many insurance experts will tell you your UMBI limits should always match your own bodily injury liability limits. If you think you're worth protecting others for up to $250,000, shouldn't you protect yourself for the same amount? Then there's the underinsured part. This is just as dangerous. Let's say the person who hits you does have insurance, but they only carry the state minimum. In many states, that might only be $25,000 in bodily injury liability. If your medical bills are $80,000, their policy will pay out the $25,000 and then that's it. You're left with a $55,000 gap. This is where underinsured motorist coverage kicks in. It covers the difference between your costs and the other driver's low liability limits, up to your own policy limit. It's a safety net for your safety net. And don't forget about property damage. Uninsured motorist property damage, or UMPD, helps pay to repair or replace your car if you're hit by an uninsured driver. Now, in some cases, your own collision coverage would also cover this, but using UMPD can sometimes be advantageous. For one, the deductible for UMPD is often much lower than a collision deductible, sometimes as low as $250. In some states, UMPD can also cover hit-and-run accidents, where collision coverage is your only other option. It's a crucial conversation to have with an Encompass agent to see which structure makes the most sense for you and your state's laws. Now let's talk about your immediate well-being, regardless of who is at fault. This brings us to the next layer of personal protection: medical payments coverage, often called MedPay. Think of MedPay as your accident health insurance. It's a small but powerful coverage that pays for medical and funeral expenses for you and any passengers in your car who are injured in an accident, no matter who caused it. The beauty of MedPay is its speed and simplicity. While liability claims are being sorted out, which can take weeks or months, MedPay can start paying your doctors, the hospital, or the ambulance service right away. It's no fault, so there's no argument over who was to blame. You were in an accident in your insured vehicle, you were hurt, so it pays. People often ask, well, I have good health insurance. Why do I need MedPay? It's a great question, and there are 3 key reasons. First, health insurance has deductibles and copays. MedPay can be used to pay for those out-of-pocket costs, so you literally pay nothing for your initial medical care. Second, MedPay is broader than many health insurance plans. It can cover things your health plan might not, like dental work if your teeth are damaged in a crash, or ambulance fees. Third, and this is crucial, MedPay covers your passengers. If you're driving your friends or family, their medical bills can be covered under your MedPay, which can save them from their own high-deductible health plans and prevent a lot of awkward conversations. Encompass typically offers MedPay in increments of $1,000, $5,000, or $10,000. For the relatively low cost, springing for at least $5,000 in coverage is one of the smartest buys in insurance. In about a dozen states, this concept is taken a step further with personal injury protection, or PIP. These are the no-fault states. If you live in one of them, like Florida, Michigan, or New York, you'll be required to carry PIP. PIP is like MedPay on steroids. Not only does it cover your medical bills regardless of fault, but it also extends to cover other economic losses. The most important of these is lost wages. If an injury from a car accident forces you to miss work, PIP can reimburse you for a percentage of your lost income, typically up to a certain limit. This is a massive benefit that MedPay does not offer. Furthermore, PIP can cover essential services. Let's say you break your leg in an accident and can't take care of your kids, clean your house, or do yard work. PIP can actually provide a benefit to help you hire someone to perform those tasks while you recover. It's designed to help you maintain your life, not just patch up your body. The key takeaway here is that these coverages, uninsured/underinsured motorist, MedPay, and PIP, are all about you. Liability coverage protects your assets from others. Comprehensive and collision protect the value of your car. But these coverages protect your body, your health, and your ability to earn an income. They are the most personal coverages you can buy. When you're getting a quote from Encompass, this is where you don't want to skimp. Cutting your liability from $300,000 to $100,000 might save you a few dollars, but it exposes you to massive risk. But cutting your UM/UIM coverage to the state minimum, or foregoing MedPay, is betting against your own well-being in a world full of uninsured and distracted drivers. It's a bet you can't afford to lose. So we've built the core of a rock-solid policy. We've protected other people with liability. We've protected the physical vehicle itself with comprehensive and collision. And now we've wrapped you and your passengers in a shield of financial protection for your own health and income with MedPay, and PIP. This is the complete fortress. This is the kind of policy that lets you sleep at night, knowing that no matter what happens on the road, whether it's a hailstorm, a deer, another person's mistake, or even an uninsured driver, you are covered. But the policy isn't finished yet. The fortress is built, but what about the support systems? What happens when you're stranded on the side of the highway at 2 a.m.? What about the sheer inconvenience of being without your car for 2 weeks while it's in the shop? And perhaps most importantly, we've built this premium comprehensive package. How do we make it affordable? How do we find every last discount Encompass has to offer to bring the price down without sacrificing a single ounce of this critical protection? The special endorsements, the hidden discounts, and the final verdict on what it's really like to file a claim with Encompass. That's where we're going next. Let's start with those special endorsements, because this is where a standard EncompassOne policy transforms from an off-the-rack suit into a bespoke, tailored piece of armor for your financial life. These aren't just bells and whistles. They are strategic upgrades that address specific, high-risk scenarios. First up, and arguably one of the most valuable for anyone with a newer car, is new car replacement. We've all heard the horror stories. You drive a brand new $30,000, $40,000, $50,000 car off the lot, and the second the tires hit public pavement, it loses thousands in value. If you get into a major accident a few months later and your car is totaled, a standard policy will only pay you its actual cash value. That's the depreciated value. You could be out thousands of dollars still owing money on a car that no longer exists. New car replacement coverage from Encompass flips the script. If your new car is totaled within the first 2 model years and has fewer than 24,000 miles, they won't just give you its depreciated value. They'll pay to replace it with a brand new car of the same make and model. This isn't just a feature. It's a shield against the brutal reality of vehicle depreciation. Next is accident forgiveness. This is your one get-out-of-jail-free card. With many insurance companies, a single at-fault accident can cause your premiums to skyrocket for years, costing you hundreds, if not thousands of dollars. With Encompass, if you have this endorsement, your first at-fault accident won't result in a rate increase. It's a loyalty reward, a way of saying, we know good drivers can have a bad day. This provides incredible peace of mind, knowing that one mistake won't derail your entire budget. Then there's the electronic equipment coverage. Think about the technology packed into modern cars. It's not just the stereo anymore. We're talking about custom navigation systems, rear seat entertainment screens, high-end speakers, and more. A standard policy often has very low limits for this kind of equipment, maybe $1,000. If you've invested in a premium sound system or other aftermarket tech, this endorsement ensures it's properly covered for its full value, not just a fraction of it. But the real secret weapon in the Encompass arsenal, the one that truly sets it apart, is the company car or use of other car endorsement. This is a game changer for a very specific but growing group of people. If you're given a company car for both business and personal use, you might assume you're fully covered by your employer's policy. But what happens when you rent a car on vacation or borrow a friend's truck to move a couch? You personally don't have an auto policy, so you have no liability coverage that follows you. This endorsement extends your liability protection from the company car to any vehicle you drive. It's a critical gap filler that most people don't even realize they need until it's too late. Now let's talk about bringing the price down. Because even with a premium product, nobody wants to overpay. The key with Encompass isn't to look for coupon codes online. It's to work with your independent agent to strategically stack discounts. The obvious ones are there. Bundling your home and auto, being a safe driver, having safety features like anti-lock brakes and airbags. But we need to go deeper. Ask your agent specifically about the good student discount. If you have a driver in your household under 25 who maintains a B average or better, this can be a significant saving. Don't just assume it's applied. You often have to provide proof, like a report card. Then there's the defensive driving course discount. Many states have approved courses, often available online, that can knock 5 to 10% off your premium. It's a small investment of time for a multi-year reward. Dig into the paid-in-full discount. If you can afford to pay your entire 6-month or annual premium upfront instead of in monthly installments, Encompass, like many carriers, will give you a noticeable discount. They save on administrative costs and they pass that saving on to you. And here's one many people miss: professional and alumni associations. Are you a teacher, an engineer, a nurse, or a member of a university alumni group? Encompass has partnerships with hundreds of organizations. A simple question to your agent: are there any discounts for my profession or the university I attended? Could unlock savings you never knew existed. The agent is your guide here. Their job is to find every last dollar of savings you qualify for. Make them work for it. Okay, we've built the perfect policy. We've applied every discount. But none of it matters if the company disappears when you need them most. This brings us to the moment of truth. The claims process. What is it really like to file a claim with Encompass? Because Encompass is a subsidiary of Allstate, you get the benefit of a massive nationwide claims infrastructure. This is not a small regional company that might be overwhelmed by a major catastrophe. They have a 24/7 claims hotline and a robust online portal. When you have an accident, the initial report is typically smooth and efficient. You'll be assigned a claims adjuster who will be your main point of contact. Here's where the independent agent model shines again. If you run into any issues, if you feel like the adjuster isn't being responsive, or you don't understand part of the process, you don't have to navigate a faceless corporate call center alone. You call your agent, the person who sold you the policy. Their job is to be your advocate, to get on the phone with the claims department on your behalf and push for a resolution. This single point of contact, this advocate in your corner, can be the difference between a stressful nightmare and a smooth, supported recovery. In terms of satisfaction, the data is generally positive. Allstate's claims handling frequently scores at or above the industry average in J.D. Power studies. They have the financial strength, with an A+ rating from AM Best, to pay out claims without issue. The process is professionalized and streamlined. They have a network of approved repair shops, which can make getting your car fixed faster, though you always have the right to choose your own shop. However, no company is perfect. The most common complaints, when they do arise, often center on disagreements over the valuation of a totaled vehicle or the time it takes to get a final settlement. This is an area where any insurance company can fall short of a customer's expectations. The key is communication. A good Encompass agent will help you set realistic expectations and will advocate for you if you believe a valuation is unfair, helping you provide the necessary documentation to support your case. So, after all of this, what's the final verdict? Who is Encompass Auto Insurance really for? Encompass is not for the bargain hunter. It is not for the person who spends hours online trying to shave $12 off their 6-month premium. If your sole priority is finding the absolute rock-bottom cheapest price, you will almost certainly find it elsewhere with a direct-to-consumer carrier that has lower overhead. Encompass is for the discerning consumer who has more to protect. It's for the household that owns a home, has multiple vehicles, and maybe even a boat or an RV. It's for the person who understands that insurance isn't a commodity. It's a critical component of a sound financial plan. The ideal Encompass customer values advice and relationships. They don't want to deal with a chatbot or a different call center representative every time they have a question. They want to have a name and a number for a professional agent they can trust, someone who understands their specific life situation and can tailor a comprehensive protection plan that covers all their assets under one simplified policy. They are willing to pay a slight premium for superior coverage, for features like a single deductible, and for the peace of mind that comes from knowing they have an advocate on their side when things go wrong. So, the bottom line is this: if you're just starting out, have a single older car, and are renting an apartment, Encompass is likely more insurance than you need. But if you're an established homeowner with a family, multiple valuable assets, and a desire for a premium white glove service experience, then Encompass should absolutely be on your short list. Your final step isn't to call Encompass. It's to find a highly rated, local independent insurance agent. Tell them you want a comprehensive review of your needs. Tell them you want to see a quote from Encompass, but also from other comparable carriers like Chubb, Pure, or Cincinnati. Let them compete for your business. Use the knowledge you've gained from this series to ask intelligent questions. Question the liability limits. Ask about endorsements. Challenge them to find every discount you deserve. You are now in the driver's seat. Because the goal was never just to buy a policy. The goal is to buy the right policy. To buy certainty in an uncertain world. To know that if the worst day of your life happens, you've already made the smart decisions to ensure it doesn't become a financial catastrophe. That is the true value of great insurance, and now you know exactly how to find it.